So there's something we need to talk about before we get deeper into learning the order flow tools, because order flow, like any tool, can be misunderstood, misread, and misused. Most traders do not lose because they lack intelligence. They lose because they are solving the wrong problems. The typical trader approaches the market looking for answers to questions like, what indicator should I use? What patterns work best? What are the best confirmations to use at my key levels? Or which entry model has the highest win rate? These questions assume that outcomes are driven by strategy selection, but they are not. Markets do not reward strategy, they reward correct interpretation of context and behavior. Most losses come from this misalignment. It's like trading breakouts in a balanced market or trading reversals in an imbalanced market, or maybe reacting to volume without understanding liquidity or interpreting effort without measuring results. These are not execution mistakes, they're context reading mistakes. Another major issue is timing. Most traders act or enter way too early, and they anticipate instead of simply observing. They predict instead of confirming. They also assume permission instead of waiting for it. And this is not necessarily impatience, it is a misunderstanding of how markets authorize movement. So now, there's also a massive confusion between activity and opportunity. A lot of traders think high volume feels very important or fast movements feel urgent and they think this is heavy strength. But none of those guarantee that the market is offering favorable conditions at all. Without context, activity is just noise. Now, most traders also overweight confirmation tools. We see a lot of people stacking indicators and searching for confluence, and they assume more signals equal more certainty. And I know a lot of y'all have already been through that because a lot of educators in this space keep searching for anything to make their strategy work better. But in reality, this often increases confidence without increasing accuracy. So tools do not create edge alone. They only describe behavior. And when that behavior is misread, tools only amplify the error. That's very important. Now, this is only some of the issues traders are facing. There are tons more to discuss. You know, traders I see traders often get round tripped on their trades. They're trusting entry models blindly. They're not taking profits. They're adding to losing trades. They're moving stop losses back, and a ton of different psychological issues. But every problem can have a solution. So what is the solution here? The solution is obviously not another setup or entry model, strategy, or indicator. We don't need more of those. The solution is the right set of tools and a complete trading system. And that system I like to call the rule of seven. Now, this is a system I have used and developed, and it's the bedrock of everything I teach. Not because it's crazy or complex or shiny, but it's because it's very complete and a thorough system. And through this system, it offers a solution to every problem I have faced in my trading journey. So, every professional trader, whether they realize it or not, operates inside these same seven categories. And every single trade you take must pass through all seven phases. Those phases are context, location, level, confirmation, execution, trade management, and risk management. Each one of these is a skill every trader must be proficient in. Now, if even one of these is missing, the trade is incomplete. And incomplete trades are where most losses come from.